Welcome to our real estate investor workshop, whether this is your first time joining us or you've attended other sessions. My name is Michael Matthew. I've been a professional accountant for more than 30 years. My international practice is increasingly focused on real estate and real estate investors. I'm also the CFO for a home builder. I provide services including entity structuring, setting you up both in Canada and the US, operational and tax consulting, tax return preparation for both Canada and the US, and I'm also an investor myself. I own a nearby condo in Canada, and I'm currently looking for small apartment buildings in the US, initially in Texas. The plans for the group are to meet on the last Thursday of the month, subject to change around holidays, etc., at 7 p.m. for about an hour. I deliver most of the content with occasional guest speakers. We deliver topics including additional considerations for investors with U.S. properties, accessing other allied professionals, obtaining financing, maintaining records, how to file your taxes properly, etc. Now, to keep my lawyer happy, a brief disclaimer. None of the information provided in this presentation or provided through this presentation is meant as tax, accounting, or legal advice, and it shall not be relied upon as such. None of the material is to be construed as a solicitation, recommendation, or offer to buy or sell any security, product, or instrument. And while I do my best to keep things as up to date as possible, we are subject to both the legislation and court decisions are subject to change at any moment, and there are the ability for the legislation to be implemented even retroactively. So please do check with your advisor before undertaking any actual real estate transaction. So if you have questions, you can either just unmute yourself or raise your hand electronically using the reactions button at the bottom of your screen. If you have more detailed questions, you'd like to have a one-on-one discussion, you can schedule a free 15-minute session by emailing me at the address on the screen, michael@mmcpaca.com, to arrange a mutually convenient time for us to speak. All right, so let's get started on tonight's topic. What we're going to cover is common rental property expenses, other documents to submit, UHT, underused housing tax, which is new this year, changes to foreign accrual property income, or FAPI, which affects those of you who invest outside the country. And we'll go over some forms for rental income, capital gains, home office expenses, vehicle expenses, and income and expenses for non-HST registrants and for those that are registered for HST. So in the common rental expenses, in alphabetical order, I'm just highlighting some of the more important ones. So advertising would include online ad costs, for rent signs, etc. Auto expenses, things are a little bit trickier because there's different rules if you own one property versus when you own more than one rental property. If you only own one, you can deduct your motor vehicle expenses only if the rental property is in the same general area that you live in. You do the repairs yourself for the property, and you have vehicle expenses to transfer tools and materials to the property. You can't deduct the expenses you incur for the purposes of collecting the rent if you only have one property. If you have more than one property, in addition to the expenses I just mentioned, you can deduct auto expenses incurred for the following reasons: collecting rent, supervising repairs, or generally managing the properties. One little distinction on that is you have to have at least 2 different rental locations, not including your principal residence. So if you rent out your basement apartment and have one other single family detached home as a rental property, that does not qualify. So you have the more limited deduction for vehicle expenses. Capital cost allowance, that is the term that CRA uses to represent depreciation or wear and tear on enduring assets such as a building. It allows you to defer a portion of the income on your property when you sell it. Excuse me, until the year you sell it. When you sell it, all the regular CCA deductions you've taken throughout the year have to be reported as income, assuming, of course, you have a gain on the sale of the property. This is called recapture. And when you're in a area such as the Greater Toronto area or Vancouver area, where prices tend to go up quite a bit, recent months aside, you may not want to claim this CCA at all, because doing so will ensure that you pay tax at the highest tax bracket possible, which in Ontario is currently 53.5%, because the sale of your home will push you to that high bracket. And if you're in an area where the appreciation is much lower, then claiming the CCA makes much more sense. You also don't want to claim CCA if you're renting out a part of your principal residence, so that you can keep the principal residence exemption available to shield as much of your gain as possible. Financing charges, it's often one of the most missed deductions for real estate investors. If you have to purchase mortgage insurance or pay finder's fees to, say, a secondary lender, you can deduct these over time, typically the term of the mortgage. Home office expenses, this was an area of some controversy when it comes to real estate investors, but there is case law to support the deduction of things like cell phone and internet charges, which are not prorated, and things like rent, property taxes, utilities, they are typically prorated as a ratio of the square footage of your office as a fraction of the total square footage of your home. So as an example, if you had a home office that was 200 square feet, your entire home was 2,000 square feet, then you get to deduct 10% of your mortgage, interest, insurance, etc. Insurance, you're going to need this obviously for protection against significant losses such as damage from a fire or flood or vandalism. Line of credit interest. This is very common for real estate investors to start out by refinancing their home to obtain the down payment, and the interest on that loan is typically deductible. Professional fees, so fees paid to prepare your tax return, are typically deductible. Interestingly enough, and I think we'll cover this a little bit later, legal fees are usually not deductible because they go into the cost base on the purchase or a selling expense when you sell. Again, with mortgage, it's the interest that's deductible, not the principal. The breakdown between the two is usually available on your annual mortgage statement, typically received at the beginning of the following year. So sometime in January, February, you should get that from your lender, and they'll have the exact figures of what you paid for mortgage principal and mortgage interest. So again, if you have any questions, you can raise your hand using the reactions button on the Zoom controls, or you can just unmute yourself and ask the question. If you hire a property manager or use a realtor to find a tenant for you, these are both deductible expenses. Just make sure you get an invoice from them to support the expense claim. Municipal property taxes and utilities are generally deductible, and they're often missed for the portion of the year when there's a purchase or a sale. And these are adjustments that are typically listed by the lawyers in a document called, oddly enough, Statement of Adjustments. So you just want to check that, because you won't see the breakdown between the previous owner and yourself as a buyer, or the purchaser and yourself as a seller, other than in that statement. And repairs and maintenance are typically deductible. The tricky part is to determine whether an expense should be capitalized and written off over time. This would be things like major renovations, you put in a new roof, you added a deck, that sort of thing, or if they should be expensed immediately because they're just routine maintenance, such as painting of the unit. If you have a fix and flip business, because it's a short-term thing, some of those expenses that are now immediately able to be written off include things like broker's fees, commissions, land transfer taxes, legal fees, renovations, and title insurance. If you were simply just renting this home out, then that list of expenses would all be added to the cost base of your rental home. So just to branch out a little bit to the other documents that you're going to need to pass on to your tax preparer, any kind of income slip, so things for interest, dividend, employment income. If you took an advance on your RSPs, in other words, cash them in, if you're getting pension income, all that sort of income will generate a slip, and those should be in your possession. Well, it's supposed to be no later than next Tuesday, being the 28th, or the end of the month of February. If you have investments in securities, stocks, and so on, you're going to look for a statement of realized gains and losses, but that's only if they're held outside your registered accounts, RSP, RIF, TFSA, because if you hold stocks inside the registered accounts, any gains are not taxable. So we don't need to deal with those. And you're going to also need to supply the details of any disposals during 2022, including information to support the original purchase price if the statement I just mentioned is unavailable. And typically where this comes into play is you bought the securities in the previous year. So in this case, it'd be 2021 or earlier, and then you didn't sell them until a subsequent year, i.e. 2022. The slips often don't show you the purchase price in that case. And if you don't record the purchase price, then 100% of the sales price will be taxable, which is obviously not what you want. In terms of deductions, standard deductions are things like donation receipts, both political and charitable, medical receipts, and need to show the categories that are seen there, which is date, patient, who was paid, and the nature of the service, and of course, the amount. And the idea of that is if you give that details, and hopefully CRA won't ask you to send in all your receipts if in fact you're filing electronically, which most people do, and is certainly something that CRA is encouraging / forcing people to do. Okay. And other common receipts are for RSPs, tuition, and if you have a disability credit form. Now these, when they're filled out, typically there's listed a time frame they're applicable, so you don't need to get this done every year. But if you did have one supplied in previous years and is still applicable to the current year, make sure that your tax preparer knows that. And if you have any dependents, you're going to need to supply details about them, including things like their name, date of birth, the relationship, social insurance number, if they have it. Often young children don't, and their net income, if any. All right, this is a new tax, underused housing tax. It just came into effect as of last year, 2022. And it's a 1% tax that's imposed on Canadian residential properties that are owned by non-citizens or non-permanent residents, unless there's a specific exemption. There's many corporations out there, in particular, Canadian-controlled private corporations who own real estate, may be exempt from the tax. So as long as they don't have foreign ownership that's 10% or more, they will be exempt, but they still have to file the return. And I think that's where a lot of them are going to get tripped up. Note that this is not part of the corporate tax return or the personal tax return for that matter, but rather it's a separate 6-page return, and it's due April 30th, regardless of your corporate year end. So many corporations have a December 31st year end. Their tax return is then due at the end of the subsequent June. So June 30th, in this case, 2023. But if they waited until then to file the UHT return, they'd be 2 months late. They've introduced this concept of affected owner versus excluded owner. And the affected owner is the term that CRA uses to refer to a person who owns a residential property but is not an excluded owner. And this is where the corporations get caught. So excluded owner applies if you're an individual who is a Canadian citizen or permanent resident of Canada, also is excluded if you're a Canadian corporation that's publicly traded. And if you are acting as a trustee for a mutual fund, trust, a REIT, or a specified investment flow-through trust. So what will get caught by this requirement to file the return are the corporations and trusts that are privately owned. As I said, it's reportable based on April 30th. The reason why trusts are caught is because this return references the legal ownership, not beneficial. So many people have set up a corporation to be the beneficial owner of the property, but they themselves are the legal owner. Now, why would you do that? Well, you might want to do that because getting a mortgage is easier and cheaper if you get it in your personal name, but you want legal liability protection that a corporation offers. And by purchasing it in your name, but in trust for your corporation, you're able to accomplish all those goals. And here's where I'm mentioning this actually for the second time in the presentations, because the penalties are extremely severe. It's 5,000 for an individual and 10,000 for others, so the corporations, even if you don't owe any tax. And if you owe any tax, then there's additional penalties that will apply. So it's very punitive. I'm not exactly sure why they went so broad with that, but it will catch a lot of people, and maybe that's why they did it, to get the money. I'm not so sure. So the takeaway on this one: corporations who own Canadian real estate, including those who are part of a bare trust arrangement, will have additional reporting requirements and possibly more taxes to pay. Changes to the Foreign Accrual Property Income Rules, or FAPI. This affects you if you're invested in real estate in a foreign country, for instance, the US, but it applies equally to any country. And essentially it means there's a number of rules to determine this, but if you and your family control the foreign affiliate, then you have to report that income in Canada. And there's a calculation that's done based on what they call a relevant tax factor. For corporations, it's currently 4, and the relevant tax factor for individuals is 1.9. The proposed legislation would mean that this factor would be the same for both. So it would become 1.9 even for corporate shareholders. What this means is if you own US real estate, you're going to be directly affected if this passes as it is proposed in the April 22 budget. As of today, I checked again, it still hasn't been given royal assent. So there's possibility that will change, but nothing certain. If you are affected because you invest outside the country, I suggest you contact your MP and ask that they not change this, because it's just going to end up meaning you pay more tax on your investments in foreign real estate. So for rental income and expenses, this is just some spreadsheets I've done to make it easier for my clients to get me the information. We've talked a little bit about some of these expenses earlier, so I won't go over them again, but there's a few new ones here, salaries and wages being one of them. So if you're paying, say, a handyman to look after a small apartment building, then obviously that will go into your list of expenses to be deducted. The order here is just based on the order of the forms. Just it makes it easier for the tax preparer to enter things quickly if it's in the same order. So I think this is, we've talked about most of these before. For capital gains, the basic formula is simple. What is not necessarily simple is making sure you have all the information you need on hand. So it's just sales price less the adjusted cost base less the outlays and expenses gives you your gain, half of which is taxable. So those outlays and expenses include things like you see on the bottom of the sheet, which are legal fees. If there's a mortgage, there's often a interest charge or other fee to discharge the mortgage, the legal fees, and the commissions. Those are sort of the major categories. In order to calculate the ACB, or adjusted cost base, you go back to the purchase price, and you would have added to that the legal fees, the land transfer taxes, title insurance, any capital improvements. So again, my favorite example seems to be a deck. So if you've added a deck to the property, then all that goes into the adjusted purchase price or adjusted cost basis, and all that gets deducted. Now, if you're like many people and you actually deducted the legal fees fully when you bought the property, obviously you're not going to deduct it again here, but technically you were not supposed to deduct it when you bought the property. It just gets added to the carrying cost of the property. And if you've had the property for a while, obviously the importance of record keeping is made fairly evident here, because I certainly wouldn't remember something I did to the property 10 or 15 years ago unless it was really dramatic, like I did, put in a whole new roof or something. But the best practice for that is you start it with your purchase price that you get from the lawyer with all the purchase documents, and you just keep a running total of any additions to it over the years, so that when you come to file taxes for the year that the property was sold, you have all the figures you need at hand, which makes it a very simple exercise to put them into a spreadsheet like this and to be able to calculate the gain. Home office expenses, we talked about this a little bit earlier. Typically, you're looking at a ratio of the area of business to the total area of the home. So that gets you a certain percentage. Percentages I see are 5%. I think the maximum I saw was 33%. And that was someone who was a computer technology specialist, had a tiny apartment, and literally had computers in every room, I think, except the bathroom, because he needed to have so many systems at hand to support various clients with different systems. But that's exceptional. Most people are in the 10 to 20% range, and you're able to claim these expenses on that prorated basis. I want to point out again that there are other expenses. Primarily, I'm thinking of cell phone charges and internet charges that are not prorated. And I think that's probably a common mistake I see, is people think everything to do with the home office is prorated. No, that's not true. For cell phone business, especially if you have a landline, I think there's a few of us out there that still have a landline, you would be legitimately able to deduct 100% of your cell phone charges for business purposes. Vehicle expenses, again, it's done on a ratio basis of business kilometers to total kilometers driven in the year. So as an example, let's say you drove 30,000 kilometers for the year and 20,000 were for business. So 2/3 or 67% of your expenses would be deductible to the business. If you're not an HST registrant, in other words, you can't claim the HST that you paid out as an input tax credit on your HST return, then you wouldn't need that middle column and you just work with the total column. So these are the common expenses for someone who's reporting their business income on their personal tax return. Obviously, some of these don't apply if you don't have a goods-based business. So if you're in the service business like myself, I'm not buying a product to resell. So I wouldn't have any purchases or direct wage costs and that sort of thing in that section. Meals and entertainment is 50% deductible. So let's say you spent 5,000 on meals during the year. The actual deductible portion is half that, 2,500, which I think most people understand now. But what they don't understand is that also applies to the HST. So normally, as you know, HST is 13%. You would only get to claim effectively 6.5% or 13% divided by 2 as an input tax credit on a business meal, because CRA deems that 50% of both the expense and the HST is a personal benefit to you and therefore is not deductible or claimable. You may have things that fall outside of these categories listed. That's where the other comes in. Just as a best practice, I try to fit things according to the categories that CRA uses and have listed there. If it's truly not a fit at all, then of course you'll have to specify under the type of expense. But as much as possible, I think it's a good practice to follow their headings because that's what they're used to seeing. And of course, the difference in the second slide here is that you are an HST registrant. It's important to understand that HST does not apply to all these expenses, and people who use a simple formula to extract the HST because they're not going from the slips themselves, which is always dangerous, can fall into this trap. So some of the ones that don't have HST included would be things like wage costs. Subcontract costs may have HST, depends on whether the subcontractor is registered. There's no HST on things like bad debts, insurance, interest, salaries, wages and benefits, property taxes. None of those have HST on them. So the basic rule is you can't claim that you paid HST if you weren't actually charged HST. So if you go from the slips themselves, you're never going to have a problem with that claiming HST incorrectly. So to summarize that, basically, tax changes happen frequently, can affect your existing or future investment activities and business activities. And by providing all the required information to your tax return preparer, you'll get your tax return filed faster, maximize your deductions, and will likely save money. Our next event will be March 30th, so that I believe is 5 weeks from tonight, again at 7 o'clock Eastern, and the topic will be announced later. So if you have questions on any of what we just talked about, or just generally about real estate, please go ahead and unmute yourself or type it in the chat, whichever is easier for you. I've also put my contact information in the chat if you want to copy it from there. Any questions for me tonight? I know for some of you, this may have seemed very straightforward, but as the person who prepares the actual tax returns, I can assure you that 90% of my clients are not as organized as they could be, particularly when it comes to giving the information on real estate, and where they often don't get it to me initially completely is with all those costs that we looked at that get added to the purchase price or get deducted from the sales price. So do keep track of those. And obviously, in order to do that, you can adopt the procedure of getting rid of your records 7 years after the fact, because you may hold on to a property for quite a bit more time than that. Okay, well, just point out that if you need to save the chat, there's 3 dots at the bottom of the chat window. If you click on that, the first menu item is to save the chat. So I'll just give you a minute or two to do that if you like. Okay, so I guess we'll do an auction style, going once, going twice, going 3 times. If you have any questions, now's the time to ask them. But it seems like that's it for tonight. Okay, well, thank you for tuning in. Hope to see you here on March the 30th, and have a great night. Bye, everybody.